Good afternoon. Welcome to another LBMA webinar. It's good to be back, and I couldn't think of a more exciting webinar than the one that we have today. We have Ross Norman, who will be playing host to Suki Cooper at Standard Chartered, and Jim Steele from HSBC. And I just wanted to let you know that, as always, we welcome your questions. Please just submit them via the Q&A panel at the bottom of your screen or your computer screen, phone screen, and we will do our best to answer these at the end of the webinar. So Ross, when you're ready, I hand over to you.
Thanks very much indeed, Tyler, and thank you, LBMA, for organising this event. It's very kind of you to have done so. If you joined us for the first of these two-part webinars, you'll know that in the previous one, I was joined by two world-class leading precious metals experts, Suki Cooper from Standard Chartered and Jim Steele, Precious Metals Analyst at HSBC. So join me, if you will, by putting these guys under some pressure, if you like, by putting some questions to them towards the end of this, and we'll address those then. Just 3 weeks ago, we were looking at the election and wondering what the likely outcomes were and how it could affect the economy and indeed precious metals. The general view of us was that a blue wave was probably the likely scenario, which would be gold positive. That view, I think, was vindicated in large part because on November the 3rd, during the elections, there was a moment in time when the Trump administration was in the lead for a brief period, and gold fell from 1905 to 1880 before bouncing to 1960 as the Biden administration to come looked like the likely outcome. So an $80 swing on the day. 3 weeks on, the actual decision remains a matter of question because it's under dispute, but the likely outcome is that Biden will be the 46th president of the USA, and the likely outcome is that the Republicans will control the Senate if Georgia goes the way expected. So joining me, Jim, going to you first off. Number one, two questions really. We feared a divided Senate. We've got that. Actually, the market seems to have ignored it. And going on from that, what do we think a split house means for the economy and by extension gold?
Well, thank you, Ross, and thank you again to the LBMA for their gracious invite to address everybody. I think what we're going to get now with very likely, we know for a fact that the Democrats holding the House, although they lost a few seats. It looks almost certain that it will be Biden in the White House. So I don't think, although as you said, it's disputed, it's not contested in that sense. And I'd make a distinction between those two words. That would have been very bullish for gold had it been contested. The likelihood that the Senate will be retained by the Republicans gives us the potential for gridlock, despite the fact that Biden is trying to reach over the aisles, so to speak. Now that's going to reduce any likely fiscal stimulus. I mean, the Democrats had proposed a fiscal plan between $2.2 and $3 trillion, which equated to 11 to 15% of US GDP, an absolutely enormous number. The Republicans initially came out with $500 billion, 500 billion. So that we're going to get something probably in the middle of that, and that's going to reduce the deficit, reduce what the deficit would have been otherwise, and that's going to be slightly negative for the gold market.
I mean, the key thing here is that Mitch McConnell, a bit like Senator Biden, knows his way around Washington. And Mitch McConnell, who's the head of the Senate expected to be, has quite a track record in thwarting the Democrats. I think he did it 6 times under President Obama. So the likelihood is more of a gridlock. I mean, the question is really, are you going to have the Republican Senate reducing the more extravagant hopes of the Democrats? Or do you just have simple gridlock where neither happens? You've got 2 seasoned campaigners in there, haven't you? So the gridlock seems to be the likely story looking ahead for the next year or so.
Yes, but it's going to result, it results because we need to have a budget. It's going to result in a reduced one from what the Democrats would have expected. And importantly, Ross, because as you know, the gold market, like every other market, is built on expectations. And so since we expected a clean sweep, the market had to recalibrate because we're not going to get that fiscal stimulus that we had initially, that was initially more likely.
We'll come back to you, Suki, on your views on this, but Jim, take that forward, if you will, a bit now, looking over 3-6 months, what this means for the economy. Let's assume the Democrats have the presidency. Let's assume the Republicans have the Senate. What kind of, paint me a picture of what the world looks like in 2021, the economy and by extension gold. What are we looking at?
Well, it's hard to say if really it's going to alter that, mean that much for the global economy. We are set to recover. I think our view is that we're bouncing to about 4.8% global growth, weighted slightly more towards emerging markets than to the developed markets. But the issue of the US would be also for a spring back. The recovery has been, but the recovery, I mean, in our view, is patchy and somewhat opaque. It seems to favor some countries and some markets rather than others. And I think you've got to look for the countries that have a high beta towards the US, because the US has bounced back. And I know we're not going to devote the time to the COVID issue, but that has reemerged and has a potential to slow everything down for everybody.
So taking that one step further, Jim, if I can, what does this mean for gold? What that environment you're seeing, looking 3-6 months ahead, where does gold fit into that world?
Well, here's what's somewhat ambiguous about gold is the risk on, risk off attitude. If risk off, you would think intuitively would support the gold market, but it won't if it rallies the dollar. And that's what we've seen. We've seen recently the dollar gained as money has gone into US assets and treasuries, as uncertainty has reemerged and the stock market has been volatile. And this is, if it gains the dollar, the whole fiscal issue, actually getting back to the dollar and its influence on gold, the whole fiscal issue gives dollar bears a headache. Because had we had a bigger fiscal package, which would have been the case under a clean sweep, you could have been more dollar bearish.
Right.
Now that's not the case. So that is going to act as a stopper against the gold rally, despite the fact that we're in an uncertain world.
I know, Suki,
does that answer the question? Does that?
Indeed. I know, Suki, you had a particularly negative view of the dollar looking forward, but before you come on to that, did the split government that we have, the gridlock possible, as we talked about there, how do you see that playing out for the economy and for gold by extension, with a particular reference to the US dollar?
The main points that Jim has already mentioned, the fact that the fiscal stimulus is likely to be smaller than what it could have been under a clean sweep. We're most likely going to see a more collegiate approach when it comes to global trade. A number of these factors actually are still quite positive for gold. If we think about other alternative assets to gold, they're probably likely to do better now. But I think one of the main takeaways from here is that if there is less fiscal stimulus, yes, that's less positive for gold in terms of inflation risk, but that also means there's likely to be more heavy lifting for the Fed. So if there's less work that's being done by fiscal stimulus, the Fed is more likely to increase quantitative easing. And they've indicated that they may do this in the December FOMC meeting. The ECB has also indicated that they might increase quantitative easing as well. So I think the looser monetary policy that we're likely to get in the forthcoming weeks is still very positive for gold and is likely to see a weaker dollar as well.
I mean, the Fed's certainly indicating it's done the heavy lifting with the monetary stimulus. It's saying to government, now it's your chance with fiscal stimulus. In other words, print and spend. Get on with it. We need to give a shot in the arm for this economy to get it going. So the Fed's kind of bouncing it back to government. The problem is if the government can't enact or can't live to those wishes simply because of this gridlock between the presidency and the Senate. So that, I see your point there, how that could be gold positive. Your view, Suki, of the dollar remains still bearish to the same extent as 3 weeks ago?
We still see further weakness for the dollar, but sort of modestly smaller extent. We were previously seeing weakness towards 1.24 against the euro. We now see it towards 1.22. So our dollar negative view still remains intact. We still think that assets outside the US are likely to remain attractive. So we still see that broadening trend remaining supportive for gold. But I think what will become more relevant for gold, the dollar has been the main driver for most of this year, I think is real rates. I think real rates will be back in the driver's seat and painting and still being very, very supportive of gold prices. We still think on a global basis, real rates are set to remain low or negative. Yeah.
Well, real rates have certainly reversed in the last few days, and that's staying with you, Suki. Gold's just gone through a 6% decline on the announcement on the 9th of November, just a week or so after the election, that Pfizer had come up with a vaccine to help us with this COVID. Technicals would normally tell you that gold should go through a 50% recovery or bounce after a sharp decline. $100 fall in gold. We didn't see a 25%, sorry, bounce, and it's mired since then. What does that tell us about gold's sentiment at the moment? Is it mired? Is it struggling?
I think gold did behave as you would expect it to under that announcement. The effectiveness was much greater than what the market had been expecting. Maybe the market was expecting around 50%, 90% far exceeded that. But there are still question marks around the vaccine, which I think still leads to some uncertainty. But in terms of gold's price response, I think this has been particularly interesting because we started seeing gold pricing in a potential Biden victory through most of last week. And of course, the CFTC data only runs to the election date. But looking at the open interest data, looking at the volume traded, it suggests that we did see an influx of fresh long positions entering the market. Now, it's unfortunate that the CFTC data will only run to Tuesday, so it will cover the vaccine announcement as well. But that same data does imply that it was long liquidation. It wasn't aggressive fresh shorts that entered the market, but it was so most likely it was weak long positions that were frothy in the market that exited. But even where prices have bounced, I think we've seen good support below 1850. Buyers have returned to the market, and they've done this again. So I think what's going to be key here is whether gold prices falls below this level and we start to see prices towards 1800, then it's much more vulnerable. But in the grander scheme of things, given that there are still question marks about the vaccine, it has responded as you would expect it to, but buyers have returned and it's stabilized. So I think that's a good sign for the gold market.
And it's easy to forget we've already had even with the decline, a 23% gain year to date, and gold can only put on so much gain, and otherwise you have demand destruction in those price sensitive parts of the world, which we'll come on to a little bit later, time permitting. Jim, if you wrote the story about gold over the last 5 years, and you looked at the quality end of the market in terms of what's been driving the market, I suspect you'd put central bank buying right up towards the top of that list. You know, it's the quality end of the market. And I'll just share with you a few figures, if I may, on the central bank side. In the third quarter of 2018 was the best on record, 253 tons in that quarter. Last year, third quarter, 142 tons was bought by central banks. Third quarter this year, they were net sellers of 12 tons. Is there a case for saying that that really important underpinning by central banks has exhausted itself, or is this just a response to the price, perhaps? I don't know. What's driving that thinking?
Well, just a quick comment, if I may, but before I launch into that question, Ross. I think Suki touched on a great point, which is the monetary side of things. You know, because of the election, because of all the talk about government spending, because of things that have been going on in the EU recently, the emphasis shifted towards the fiscal. And generally, gold is more driven by the monetary. We already have high debt to GDP ratios since World War II levels, so they're not going to change, even if the Americans' stimulus is less than expected. The other thing is that the monetary spigot is still on, and Suki couldn't be more right. And this has been clear since Jackson Hole. I mean, our long-term, our 10-year forecast for yields at the end of next year and the year after is 75 basis points, which makes them negative, likely, very, very likely negative in real terms. So this is going to continue to drive the market, and that is 100%. And that's why we don't see, I think, along with Suki, any major retracement. And even before the election, the gold market was up 18% last year. Just to put that in perspective. Now, the central banks are often not spoken about, I think, because they're a rather opaque part of the market, but they're absolutely essential because they are the main demand source, physical demand source, after ETFs and jewelry. And they've been phenomenal in the past 2 years. The decline in this quarter shows, however, is positive for gold from the aspect that gold does what it's supposed to do. Some central banks liquidated gold because they needed the cash, because they wanted to rebalance, because of the decline in trade that's been associated with the economic contraction this year due to COVID. So any central bank manager, I mean, he's going to look at that and say, gold's utility is still very high. Central bankers still have a positive view towards gold. It had definitely gone onto the back burner for many years. But the last 2 years, not counting this year, were absolutely spectacular, taking up a significant percentage of global production. And what I think is that delayed the purchases this year has been the drop in oil prices, because 2 of the 3 largest buyers are petro economies. Russia's more diversified, but petrol is a very important export, and Kazakhstan. And I would expect that stabilization in the oil price, which would go in with the recovery next year, would allow some of I'm not saying them specifically, but oil exporting countries to increase reserves. And you know, central banks do things on a very long-term projection. They've been buying for several years now, and I do expect them to be back in at a greater level next year.
And indeed, I think there was a report to suggest that the Russians were back again last month, buying 13 tons after being out the market, supporting your view there. As we're on central banks, Jim, there is a question that's come in. I mean, with the global outlook, let's say the economy looking mired in the interim, in the near future, are there any possibilities that you're aware of large-scale central bank selling on the horizon? We've seen a little bit from Venezuela, of course, different reasons. Are there any, is this the time when central banks will start to divest themselves in any size or scale?
I don't think that we're going to see anything significant enough from the major economies, for the major holders of gold, the really large ones, to divest themselves of bullion. It is the smaller, the lower medium tier and lower tier country, economically I'm speaking, countries that are more vulnerable to trade, adverse trade shifts, are much more vulnerable to open economies, are much more vulnerable to global changes that are likely to sell. And I think it would be still relatively modest levels of gold. I mean, the amount sold in the third quarter doesn't compare to the amount purchased in the third quarter of last year. But it is a good point, because I do think we might see a little bit more of this, despite the fact we're going to see some net buying coming in.
I mean, Suki, I mean, the truth is, amongst central banks, the Asian central banks in particular, are very underweight gold, aren't they, compared to the mature economies of the West? So there's a lot of catch up to still to happen, and China remains something of an enigma in terms of its holdings. There's lots of views about their holdings. Presumably, your position is much the same on central bank buying. Maybe this last quarter has been an anomaly. Is that your view as well?
We very much do think that central banks will remain net buyers. Yes, the buying in terms of volumes is likely to be much lighter. We're currently at around about 220 tons for the year to date, so maybe we'll be below 300 tons for the year to date, for the full year. But if we think about the 10-year average, that's still quite significant in terms of overall buying appetite that we've seen. And then going into next year, we still think that there's plenty of appetite to continue to buy gold. And we've had a number of surveys throughout this year, starting with the World Gold Council survey in the first half of the year, which indicated that central banks still had a favourable view towards gold. They're not as price sensitive as other buyers are in the market. They have longer term gold. And they also indicated that they were concerned about negative rates, and it could be one of the factors why they still continue to turn to gold. So I think the overall trend remains supportive, and those central banks that have sold, it's been isolated to a small number of central banks. We still have a large number of central banks buying, albeit to a much smaller extent.
And indeed, for those that use metalsdaily.com, you'll see an excellent survey on there by Invesco, a survey of central banks and their attitude towards gold, and you're encouraged to take a look at that. It's quite an in-depth
I would throw
survey.
one very, very quick thing in, Ross, is holding gold for a central bank is a marvelous way of diversifying out of the dollar without committing yourself to another currency. And that could be key, because central banks want to diversify. But in this atmosphere, you know, what would you go into? And I'm not saying any other pro or plus pros and cons of any other currency, but if you were unsure of going into the euro, if you're unsure of going into the yen, but you didn't want to be so heavily weighted in the dollars, then gold is absolutely perfect vehicle to use.
Excellent, thank you. My question to Jim, Suki, was, you know, if you wrote the picture of the last 5 years, central banks will probably appear in the first line. If you wrote the story for gold in this year, 2020, I would imagine ETFs would appear in that first sentence. I mean, the ETF sales in the first half of 2020 exceeded any previous full year. I mean, it was the year of the ETF, big time. I'll just share with you, if I may, statistics about 2020's uptake of gold through institutional investors. In the first half of this year, ETF buying was around 122 tons a month on average in H1. In the third quarter of this year, it was in July 166 tons, August 39, September 66 tons. Now, in this final quarter of the year, October was 20 tons, and November so far is actually a disinvestment out of ETFs. From 122 tons in H1, a month on average, it feels as if the institutional investors' appetite for buying gold is exhausted. Am I right or wrong there?
I think there's a few factors at play. Firstly, looking at where these buyers are emerging, it's not concentrated in just one particular country. Investors around the world globally have started to turn to gold. But for me, I think what's particularly interesting is if we think about these periods where we've had large price corrections, so going back to August 11th, later on in September, and then most recently on Monday, we haven't seen hefty net redemptions materializing. In fact, through the course of August, we only saw net redemptions of less than 20 tons. So that was the largest outflow we had over the course of a week since March. And again, in September, the outflows over the course of that week were less than 20 tons. And this is really modest in comparison to the total outflows. I would be more concerned if we started seeing hefty net redemptions materializing every time we had these price corrections. But even on Monday, we didn't see that outflow. So yes, they've started to slow down, but I would also argue that ahead of the US election, many more investors were keener to be on the sidelines just in case there was uncertainty around how it played out rather than taking a stronger position. So I think once the clarity has emerged around the vaccine, the rate of infection, what lockdown 2.0 looks like on a global basis, not just across Europe, but in the US as well, we're likely to see investors continuing to turn to gold. Yes, some of the flows might start to slow down, but I think it's net redemptions we need to keep an eye on. And then on top of this, another factor that I like to look at is just some of the quarterly filings, which gives us quite an interesting breakdown in terms of who's buying the physically backed ETFs, at least in the US. And I think what was particularly interesting for Q2 was that we were not only seeing some of those established investors who bought throughout the global financial crisis re-entering the market in substantial terms, but we also saw a number of new entrants buying gold as well. Now, the Q3 data is only just starting to come out. We haven't had the major reports for the largest holders of the gold ETF, but the data that we have had through has shown that some of the new entrants that came in Q2 have already started to liquidate. So I think, yes, there is a small element of speculative interest in the gold ETFs. I think we've always had this in the ETFs. Previously, it looked like it was around about 5 to 10% of the global ETF holdings. Currently, it looks like it might be a bit smaller than that sort of percentage. but I think we should expect to see net redemptions. And I think it will be a function of how the vaccine develops and what the fiscal stimulus looks like. The worst case scenario might be a huge fiscal stimulus boost and a strong vaccine development as well that's rolled out faster than is expected. So that might start to present an economy that's recovering much faster than we're expecting. But then, of course, there'll be concerns around inflation risk as well. So I think there are risks that we need to keep an eye on. But for now, I'd say it's still a positive trend.
Staying with you, Suki, you know, as a gold investor, I guess what I'd be looking at is with the price sensitivity of the Asian market. And by the way, there you'll see a screen reminding you, we welcome your questions. Please do type those in, and we'll address those at the very end. And thank you for that, Tyler. As a gold investor, I guess I'd be interested to know where the floor in the market is. You know, we've had this sharp correction on this vaccine news. And the thing that has been almost entirely absent for a big chunk of this year is demand from the #1 producer, India and China. Those markets have been remarkably quiet, and the void's been filled by ETF buying to take us forward. In other words, are those price-sensitive parts of the world responding to this price weakness to finally come in? What do we know about discounts in those local markets there, Suki?
We are starting to see a recovery, but it's of course from a very weak base. So compared to Q2 and compared to Q1 for China, demand is starting to pick up. The local discount that we saw in China, which was it exceeded $90 back in August, has now started to come in a little bit, and it's now less than $20. We haven't seen it at this level since March, and before March we were pretty much consistently at a premium. So that the market oversupply in China is starting to come in. We also saw a very positive response during the National Week holidays. Perhaps this was a function of less tourism, restrictions around travel, that consumers started to turn to gold. So we started seeing a pickup in terms of buying in the China market. And similarly in India, we're starting to see a recovery from a very weak base. Imports are very strong in August. They started to slow down in September. The market has swung to, it's been swinging in and out of a premium to a discount. At the moment, it's in a very small premium. And we are, of course, in the midst of the seasonally strong period for consumption. But most industry estimates suggest that we're going to be down around about 25%. Of course, Diwali falls on Saturday, and happy Diwali to everyone who's celebrating. But the buying from the jeweler side has suggested that they've certainly stocked up in anticipation that demand will pick up from the levels that we were at previously. But by all accounts, it looks like that recovery will continue to be slow. And it's important to remember that India's demand was already under pressure before we even entered the post-pandemic world. So I think the physical market will continue to recover, but it will remain very weak. But also, if you look at the share of demand that's coming from these sectors, it has been very low. And I think that is an area for concern, because I agree with you, it's the market we look to providing support. But for now, given that prices are holding quite well in the 1800s, that support seems to be coming from other aspects.
I mean, Jim, is that the HSBC view? I mean, India's had, for example, a good harvest, and as goes the harvest, so goes physical demand in those regions after a difficult year, what with tax rises and the like. And there's some sense, isn't there, that Indian demand and Chinese demand is beginning to provide a decent floor. The market's quite well supported. It may not rally ahead from here, but it's got support. Is that your view as well, Jim?
A little more reduced than that, but yes. I mean, you've got to remember that China wasn't even in the market a couple of decades ago. And their demand, along with India, has been absolutely phenomenal right up until relatively recently. So this decline, and it's all before the COVID set in, and Suki made a good point, emerging market demand was already under pressure, generally speaking, because price. These are very price sensitive economies. The markup in jewelry in India and China is very low compared to in the Western markets, where there's a strong delineation between investment gold and jewelry gold, and it's mixed in Asia, and so the premium has got to be the markup for jewelry has got to be relatively low, And when you look at the bars, I mean, 10-gram bar over 50,000 rupees. I mean, it's absolutely out of the question for most buyers, and it's going to take a very long time for it to recover. I think it will recover because these are gold-friendly societies, but it's going to take a while. And if you do just simple arithmetic and you look at the decline in the ETF in the jewelry demand, it almost equates to what came in to the ETFs, which makes the ability of the ETFs to maintain demand, excuse me, all the more important. And if we get a decline, a quick decline in the ETFs without a corresponding increase in jewelry and general bullion demand in Asia, then that's when the market's going to come under stress. And don't forget, the ETFs can liquidate faster than millions of people in China and India are likely to buy more gold, because it's very small amounts that are generally purchased. And the ETFs have shown themselves on periods of liquidation to be more sensitive to perceived or anticipated changes in Fed policy. And that's what makes me a little bit more positive on the ETF outlook, is because the big declines that we've seen historically have tended to come when investors thought the Fed was going to change policy or global monetary policy was going to change, and that doesn't seem to be in the cards. So that's why I don't think big declines in the ETFs are likely. But certainly, you know, what Suki said, moderation, yeah, absolutely. It's been going for a while. It's had a very, very good run, rather like central banks. They were going for a long while. They had a very good run too. I mean, one's got to ask if the market need to come in for a period of consolidation rather than retreat. To get really strong emerging market buying coming back in, you'd have to go back to that 2013 level where the absolute exodus out of the ETFs took gold near 1100. And that's when China emerged as a huge buyer. So I don't think just gold being down $25 or $50 would stimulate wholesale emerging market buying coming in. I think we have to be content with more moderate levels. It'll never go away though. These are gold-friendly societies.
Lovely. Thanks, Jim. I don't know, Tyler, if you've got the survey there. Suki, I'll come on to you with a question about peak gold in a minute. But before you come on to that, gives you a chance to think about the answer, Suki. Let's ask you, people watching this webinar, where you think gold will be at the end of next year, around the current levels, 1800, 1850, north of here, 1850, 1900, 1900, 1950, 1950, 2000 or 2000 plus. If you can place your forecasts, then we'll talk about that in just a second. I'm doing mine. I'm not sure you're allowed to do yours, Jim, are you?
Yes, just always stick to our previously published views. That's the issue. So.
And when you're ready, Tyler, probably you're giving everyone a second or two to respond to that. If you have the view, please share that with us. It won't be a moment. There we go. Wow, a considerable number think will be north of 2000 in a year's time. So we're talking of about another double-digit gain on gold prices, and by quite a margin, I might add as well, at 39%. We've got a very bullish audience here, Jim. That doesn't quite tally with your thinking, and Suki, that's probably north of yours as well, isn't it? Really?
We have a quarterly average for Q4 2021 at 2050. So well above 2000 would be a little bit stronger than where we're forecasting. But we think the market remains supportive for gold for quite some time yet. I think the factors that we're really keeping an eye on is the rate of infection, how markets respond to it, the size of stimulus, but really, as Jim has mentioned as well, how accommodative monetary policy remains and for how long. But all of these factors, and particularly given that our forecast also is for nominal yields to remain low, suggests that negative rates are here to stay for some time yet. So that continues to suggest that we'll continue to see more upside risk for the gold market.
Lovely.
Yeah, and our average is 1965 for next year, Ross. So that's we're not far from that. Looking for the market to be below 2000, but not much below.
Okay, lovely. So from what we've heard during this webinar, my sense is that, going back to the conversation, and correct me if I'm wrong, we're sensing a moderation in US policy, in the sense that a Democrat likely, a Republican Senate likely, some of the worst excesses of a Democrat administration perhaps ameliorated by a gridlock or a split government. So stimulus, yes, fiscal stimulus, absolutely, but less than we might expect. That might be inferred as gold negative, but actually there's still a lot more to go before we get ourselves back on track. And the vaccine correction has probably got ahead of itself. So both of those things to the negative are perhaps overcooked. We've raised the question of central bank, the decline in central bank buying. And Jim, you've said, yes, well, you know, a quarter doesn't make a year. And, you know, we can't look at third quarter this year as a typical example. We could well see a continuation of buying and central bank buying, perhaps not at the hot rate we've seen for the last 3 years, but a continuation nevertheless. And Suki, you reflected that answer really as well on ETFs, which is, you know, we've seen a massive tailing off on ETF buying over the last few months, and a slightly worrying sign. Some of those negative aspects of gold on central banks and ETFs perhaps being compensated for by buying coming in from the key markets, the price sensitive markets in Asia, in particular China and India. And that figure you gave earlier, Suki, about gold trading at a discount of $90, local Shanghai, now minus 20, less bad. And in India, now at a modest premium, suggesting that these markets are now better satisfied with the current levels. Talking of India, by the way, I know we've seen a 23% gain in gold in dollar terms. We've seen a nearly 30% gain, even after the correction, in Indian terms. So it takes a while for those markets to catch up with the new numbers. It'll be interesting, as you said, you mentioned Diwali there, Suki, the seasonal buying. I think Dhanteras must be coming up imminently. That's the big day, isn't it, for buying gold, the beginning of Diwali. It'd be interesting to see if it's as hot as the stockists believe. In short, it's apparent that our audience is very bullish gold. Our speakers are moderately, cautiously positive for gold, but perhaps not to the extreme of our viewers. That only leaves me to thank Suki and Jim for giving up your time, particularly this early hour of the day. Anything you want to add in conclusion, either of you, before I wrap up?
I just think that gold is back, has been back on the radar for some time. It's shown itself to be adaptable. Watch out, though, for if there is. I'm not saying there will be. We could always get a near-term stock market correction, which could trigger liquidation for margin selling. But that would only be temporary, I think. But I think the volatility is likely to be here, as ideas about how quickly a vaccine can be used or not be used will keep washing through the market, and it'll be compensated by heavy monetary policy. So volatility might very well be up, and it could be related to equity markets. But it's likely on any pullbacks, any sharp declines, I think would be well bought.
Anything on your side, Suki?
I think you've summed it up really well, Ross. You've hit the key points in terms of where the downside risks are. I think for us, the key factors to watch in the coming weeks are going to be whether we see other companies making similar positive development announcements with respect to the vaccine. What are some of those logistical challenges around it, whether it's cold storage, how quickly it can be rolled out. Some of the indications suggest that there might be 25 million people who will be covered by the end of the year, maybe 600 million people by the end of next year. So I think some of these factors are going to be closely watched over the next few weeks. But I think also the stimulus remains centre as well of markets focus in terms of whether we might get anything before the end of the year. So I think there's lots of moving parts. For now, there's still a great deal of uncertainty. We've perhaps passed the main event risk with the US election, but there are plenty of other factors that are still supportive. But But I think all the other factors that you've summed up there, Ross, I think are the key ones to keep an eye on.
Lovely. Thank you, Suki. Thank you, Jim. And thank you for following us. I can see we've held most of our participants. And back to you, Tyler. Thank you.
Yes, thank you so much for joining us on this webinar. It's been really great to kind of bookend the election with the three of you. I just want to remind everybody that if you do have any questions or you think of them after the webinar and you'd like to get a response from either of our three panelists, please just email us at ask@lbma.org.uk and we will forward your questions on. And for the housekeeping part of the webinar, we do have another 3 webinars upcoming. The next one will be the Silver Market Interim Report and the new uses of silver. So we have Michael Dirienzo from the Silver Institute and Philip Newman from Metals Focus. Following that, on the 26th, we have Evolution of Central Bank Gold Operations. Joining us will be Isabel Strauss-Kahn and Simon Weeks. And then following that, we're going to check in with Jeremy East and Sunil Kashyap with their Asia update to see what has happened, what has changed since we caught up with them at the end of summer. So I really hope that you can all join us for that. And once again, I thank you, Jim, Suki, and Ross for participating and making this discussion come to life.
Thank you, Taylor.
Thank you.